Good morning, traders, or good Friday. It is October 31st, 2014, 8 a.m. Chicago time. Thanks for joining. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. Huge move overnight. A surprise announcement by the Bank of Japan takes the S&P from 1990 to a high of 2016.75 for new all-time highs. A lot coming in through the news wire, so you're going to hear that noise in the background, but just need to pay attention. So the Bank of Japan eased policy unexpectedly. It sent the Nikkei 225 surging higher by 4 points, highest level since 2007. Increased the target for raising the monetary base to 80 trillion from 70 trillion. Raised the JGB, which is the bonds, buying by 30 trillion. Sharply increased rate of ETF and J rate buying will extend average maturity of JGB holdings to 7 to 10 years from 6 to 8 years. Vote was close at 5 to 4 on that committee. It is intending to pursue easing in an open-ended fashion. So this is Japan is the largest supplier of liquidity to the world. It further cut the 2015 core CPI forecast to 1.7%. So this is kind of balancing the bad news on the CPI falling. 2014 CPI expected at 1.2% from 1.3%. It left 2016 core CPI at 2.1%, and it cut 2014 GDP to 0.5 from 1%. Substantial downside risks to price forecasts still likely to hit 2% CPI in or around 2015. And the unemployment rate is in line at 3.6%. So lots and lots and lots and lots to digest here. Good news for stocks, of course, with the injection of new funds, so basically QE. Bad news on the CPI and GDP expectations or adjustments. So overall, the market has popped up again, 1990 in the ES all the way up to 2016, 2017. Pretty good swing there. Large gap to contend with this morning. Brent crude is heading for a 6th consecutive loss, which would be the longest decline since 2002. The reason is global supplies and the stronger U.S. dollar continue to weigh on investor sentiment. Crude shipments from the east coast of the U.S. have jumped to a record 109,000 barrels per day from 31,000 barrels per day in July. So there's a supply and a U.S. dollar issue going on for crude. ECB's Nowotny lifts bunds after deviating from his usual hawkish stance by adopting a never say never approach to an ECB QE program. So essentially, what does that mean? That means, he will not be taking a hard stance on ECB QE going forward. Nowotny is hawkish. So there's a lot to share here on the Bank of Japan, but you can all find that information online and read it. There's some other news, but I won't get into news too much. Again, all of you can have a look and find the same information I have. Looking ahead at the daily calendar at 8:45. At 8:45, we have 8:45 Central. We have Chicago PMI expecting 60. Now, we recall that this number actually comes out to subscribers approximately 3 to 5 minutes early. So don't wait till 8:45 to make sure that your position is managed properly. And then at 8:55, approximately 25 minutes after the cash open, University of Michigan confidence is expected. This is the final number, not the prelim. Expected at 86.4. Okay. And then looking ahead, there's not much more here. Again, this big move here is a push by the Bank of Japan. It is important for the market today to hold on to these levels, even though it's an incredibly poor auction from about 1993 all the way up to about 2005. But overall, the market's behaving as expected. Once we pushed through the 55.50, started to work our way to 87.50. I'd said last week that 87.50 is expected to give us a stall for a period, but essentially it puts new highs on deck for the year, and here we are at new highs. At 9 o'clock, the Bank of England's to announce the outcome of the Basel Committee on bank supervision. And at 11 Central, we have ECB's Visco speaking in Milan. He's a soft dove. As far as auctions, not seeing anything on deck. And just remember that heating oil and RBOB futures for the November contract options expiry today. So let's get rid of that and move on to the charts where we get to see what everyone's doing. So let's start out with the overnight session. This is a 30-point range chart here, 15-minute chart. And you could see that pretty much nothing happened after the open. Market just sat sideways during the Asian session in anticipation of the Bank of Japan release. And then the Bank of Japan comes in and just absolutely exploded upwards here. Pretty decent delta buying for the overnight session. It has had a pullback to the VWAP, the overnight VWAP at 2,375, which is also the area it paused at on the way up for some minor support, and it's just as it has sat sideways since with a sharp point of control. The volume overnight's 410,000 so far. 410,000. That includes the session between 3:30 and 4:15. In case you think your charts don't match, but it's held this point of control up here at 2011. If we look back at the big picture chart, remember 2012.75 on the December contract is the high, and we're up against 2011 here. 2011 being the area that we're trading now. So we've taken back our entire sell-off, as you can see here, all the way down to 1813. Okay. Again, I'm not here to say I told you so or whatever. I'm simply here to tell you that you have to just follow the facts, and following the facts has got to lead you to the conclusion that the overall long-term player did not participate much in the selling that occurred in October. This was intermediate term trading, and the type of action that we got is really, I think I went on day trading radio several times and said, be cautious. This looks like a pullback for further highs rather than a sell-off. It's just not, I did expect a lower test. Some of you might recall I expected a pullback to the 1900, and I expected to finish this move. I expected the market to push lower towards 1783, and I expected that to be the base for another run up and a nice cleanse for the market. But it actually found the buyers at 1813, has not looked back, and just kept gapping and gapping. Once we get through the 50% or the midway of the swing, to me, things get the probabilities for return to the low get really shaky. It's just something I've observed over the years. So today we have a large gap. As you can see here from the 15-minute yesterday. Yesterday also was Hypo 2 worked out, Hypo 1 failed. It is initially If you were here for the Trader Bite, you would have heard me say that the expectation for yesterday was for responsive buying up to 75.50 or that area, and then the expectation was for sellers to come in and start pressing and to target 66 and the 63, 62, 63 area for what's likely to be an inside day. We did get that. We got responsive buying, pulled back to the mid, new high, pull back again to just above the mid, and then it pushed to 78, and we got the seller. This is the seller I expected in Hypo 1. I expected this to be responsive up, and then the seller to step in and push, and then the expectation was if it was going to return, make a pullback, it would do so to the mid. This was a setup for me to trade this impulsive move and get a continuation on it, and it looked good, but it did not work. As you can see here, the market just could not keep a lid on the buyers, and it eventually ended up going right back up to the IB high. And once we get back up to the IB high, the probabilities are for breaking it. So that's what we did. And then from there on out, it pretty much was a buy fest, which was the second hypo that I had outlined. Again, I was speaking to someone yesterday, a stage 5 trader who needed some guidance, and it's interesting to go over how he looks at things, and I think maybe I'm not being explicit enough about the fact that even though you read other people's commentary blogs and whatnot, it seems like the game of trading, now remember, this is not suitable for everyone, but the game of trading is all about predicting where the market will go and then having it fulfill your predicament, or your prediction, not predicament. And really, that couldn't be farther from the truth, in my opinion. That's what maybe it looks like from the outside. But the goal really for trading, at least in a time frame that I'm in, is to be responsive to whatever the market is doing. And in order to be responsive to whatever the market is doing, you have to maintain an objective view on what is happening. And that's the really hard part for most people is they do a lot of work. If they do the work, they do a lot of work. They take a position or a bias on the market, and then their view is the market has to fulfill my bias, and they'll only take a trade when they feel like they're absolutely convinced that their expectation of what the market will do is absolutely true. And if they're convinced that it's absolutely true, then why do you need any risk control? Why do you need to worry about defining how much to lose and so forth? And that's really not what we're doing here. What we're doing here, and what I've sought out to change since 2009 as I came online from just trading for myself and within my prop shop, what I sought to change is that idea that I need someone else's help, or I need someone else's indicator, or I need someone else's way of trading and their setups in order to trade the markets. And your job is really to study what's happened, look at the probabilities of what's likely to happen, and then form a plan that covers multiple eventualities, and let the market tell you which one it likes to trade at that moment. Because the market's not controlled by one entity, it's controlled by a large group of traders, and any one of those traders can affect the outcome of your trade. So thinking that you know, the market, this S&P should sell, should go lower, it should or needs to, if you catch yourself saying those words, it really isn't appropriate for trading. It's better to think this is what's likely to happen, or this is what may happen, and keep your mind open to whatever happens and have a plan for it. Just like a general before going to war, you really cannot tell what's going to happen once the first bullet's fired, but make sure that you do have your plan to take care of whatever happens. And that's what the military prepares soldiers for. We are going to fall back on our training, and we're going to handle every situation as it comes, because nothing ever happens exactly as we predict. Sometimes it does in the market because there are habits to the market, but I'd like to change your mind about this and help you see that really our job is to see what happened and to just basically be on the side of the bigger force, the winner. There's no allegiance to shorts or longs. We're just looking to take advantage, take a small chunk. For example, in this move here, just looking to take small chunk there and a small chunk there and a small chunk there, and maybe buy the pullback off the mid. This is a setup for me, and so forth. I'm looking for small chunks within all this noise. I'm not looking to sell the high and buy back the low, and then buy the low and sell the high. It's a pipe dream. It's really difficult to do, and it's not necessary. There's so much that goes on between the high and the low that I believe people can take advantage of. As always, as long as you mind your risk and you keep your outlook balanced, then trading is not as stressful as people make it out to be. I've been doing this a while, and I can't imagine doing anything else. Anyway, now that I'm done with that little rant, we are up against, we've pushed through a second measured move. If you recall, I outlined these measured moves a long time ago. I have not updated my measured move studies. Didn't expect this to be up here so quickly. But we had a measured move up at 2012 quarter, right where we're trading. The next major measured move up is 200% of a larger swing, and that's at 2021.75. So that's the next target. But there was confluence here out of several measured moves all the way up to 2013.25, and we've pushed through that. So at the moment, we are just on the edge of this balance from mid-August all the way over to the end of September, to the last day of September. Here we are on the last day of October, getting a gap. It's not a good situation. You are consistently short, but it's important to consider, if you're shorting these markets, it's important to consider creating some sort of a risk plan with options or something. I would not be short naked swing this market no matter what, because you're battling not only the US Fed, you're battling the ECB, the Bank of Japan, the Bank of England, and so on. It's just the way it is. There's a vested interest in making sure the markets keep increasing in value, even if it does not make sense to you. So today we have a gap up. The gap is very high. The gap is from 1989 all the way to 2013. The probability of that gap, based on 1,400 days, the probability of that gap filling is in the 18% range. It's very low. It's too large a gap to get filled. However, as I said, you got to keep your mind open to the possibility that the market will be responsive and try to push lower. I expect that a push lower by the market is likely to see some support in the 2000 area. I'm not sure how much of this the market will take back. I suspect that we have all the makings of an open drive. Why? Because we are not in balance. We are not in an existing balance zone. We have gapped up into new territory. That is open drive territory. That's how do open drives happen? What is an open drive? An open drive is a type of open where a higher time frame, somebody with a much bigger picture view and a much higher time frame, such as a fund, institution, sovereign fund, or whatever, sees the need to participate in the market in the direction of the gap. And if that happens, then you can forget about your prior day's levels or prior week's levels or your pivots or whatever. When a higher time frame interacts with the market, you get what you saw with the Japan news. The Japan news is classic OTF activity here. There's no regard for what levels are in the way and what fibs there are and so on and so forth. It's just when those people interact, they need to have a position in the market, and they do so within a very wide range, well beyond my time frame as a day trader. Okay, so just pay attention to the fact that there's a high probability of an open drive in the direction of the gap. Otherwise, I'm looking for an open auction out of range, and I'm looking for the market to try to push lower, potentially to 2002 to close this VPOC that we have that's being carried over all the way from the middle of September. So that's the high day. We have this VPOC at 2,250. And this day is a template. This day, when I look at it as a template, it's not giving me anything solid. I've got 2008 and a quarter as a key LVN. The other key LVN is at 2000. So that's why I'm expecting that the market, if it does sell, that it'll likely find buyers in the 2000 area. So that's the primary hypothesis, though, is for a probable open drive. The news today is really big for many entities around the world, and I'm expecting it to push early. It does not mean that it'll be a sustainable trend higher, as we are in new territory, and we have fallen off of new territory pretty regularly. But the second hypothesis, which has about an equal probability of playing out, is for responsive selling down to 2000 to bring it back into an area where buyers would be interested. The market might seek out buyers by selling. That's what it does. But I am cautious here on the open. I'm going to keep my hands off. We do have Chicago PMI at about 842 to 845, 12 to 15 minutes after the open. We have Michigan sentiment final 25 minutes after the open, and once that clears out, then we'll have a better idea of who is dominating. Did the higher time frame interact overnight and get their work done already, or are there decisions being made as I'm speaking here at various desks, and the market's likely to open and make a move right off the open? In either case, I'm not a big fish enough to stand in the way. I'm going to let it play out and then step in to take a position with the side of strength. Okay, I know I'm not giving you very much to play on. However, we are in new territory. There's nothing out here as far as volume. We have not seen an auction out here. We're on the edge of balance and the previous high of year. And the market has traditionally made new highs and pulled back, new highs and pulled back. It's just continuously done that. So it might get an open drive very quick pop in through the high, and then it starts to sell, and it brings us back into areas that we can actually interact with 2000 being the key test area this morning. Okay, it's Friday. Don't stake too much of your account on a Friday. Don't ruin your weekend. There's not a single trade that is worth a big chunk of your account. Try to make your money last. That's what helps you get the education you need in order to participate in the market. So risk is king in this business, and you just need to define what it is you want to bet for every trade idea that you want to execute. Don't get too itchy to do something. Oh, there's so much action, I need to do something. As a trader trading for yourself, you have the option of not trading at all and waiting for the market to come to you, waiting for the probabilities to play on your side. Then you can participate in a wise bet. Otherwise, it's just a crapshoot, casino play. And basically a gamble when you have not defined what the risk is going to be and what the probability is that you're trading. It is key to understand this is the last day of the week. We're going into the weekend, so it's likely to die pretty quickly, and then we're likely to have an adjustment on the close before we head into the weekend. I want to remind everyone again, I am gone from November 7th in the evening until November 21st. I'll be in India and I'll try to check in every once in a while, but I will not be on and tweeting as normal. Good luck and have a great weekend.